check out the new thing we got going on. This is a chalkboard. My grandmother gave it to me. She spent 10 Litecoin on it because, you know, shit's just tanking. It's not really worth anything. I'm just playing. It's doing fine, I guess. Hey everyone, welcome back to another crypto video. Today we're going to be talking about Bitcoin futures. So first of all, if you don't know what futures contracts are, basically it's a way that a buyer and a seller can sell a commodity or some kind of resource at an agreed upon price, a specific amount over a period of time. So let's look at an example. Let's take an airline company and a fuel company. So the airline company might go to the fuel company and say, hey, I would like to purchase 1,000 gallons of fuel at $1 per gallon. Maybe the $1 per gallon, it could be the market price or it could be a little bit higher than market price, depending on whether the airline thinks the price of fuel is going to go up or down. And so they might say, okay, that contract will last for 3 months. So at the end of 3 months, the airline is required to buy the 1,000 gallons of fuel for $1 per gallon. So if the price of fuel has gone up to $2, in that case, the airline company has saved $1,000. However, if it went down to 50 cents per gallon, the airline company still has to buy that 1,000 gallons, but now they've lost $1,000 essentially. So this allows for a more stable market price. It allows the airline company to buy fuel at a relatively static price over a period of time. And it also allows the fuel company to sell fuel to make sure they have cash flow. So there's a third person in this picture here, and that's the investor. That's someone who doesn't actually want to buy the fuel themselves. They just buy based on speculation of the price of the commodity. So they might, buy in 1,000 shares at $1 per gallon if they think that the price will then double to 2 in say 2 months, and then they'll sell the contract. So they're not actually trying to own any jet fuel. They just want to gamble a little bit. So let's take that idea and apply that to Bitcoin. It's basically the same thing. People who are investing in Bitcoin futures aren't investing in Bitcoin directly. They're not buying Bitcoin unless the futures contract expires, then they're obligated to buy the Bitcoin. But generally, the same concept applies where they'll try to buy in low and they'll wait a little bit. When the price of Bitcoin rises, then they'll try to sell the contract to somebody else. So now let's talk about what you're really interested in, and that's the price of Bitcoin. So the first market that the Bitcoin futures contract were available on was, I believe it was called CME Group. And when that happened, the price of Bitcoin went up by 16%. I think it broke 14,000, maybe 15,000 at that point. And then the second exchange that the Bitcoin futures contract came out on, the price of Bitcoin then went up and actually broke the $20,000 barrier. So now I know that the Bitcoin futures contract might not be the exact reason why the price rose, but around that time the price did rise. And that's something to be expected, because now you're having people who couldn't invest in Bitcoin before, people who were speculative of the market and didn't want to own any Bitcoin. Now they can buy and invest in Bitcoin indirectly on a regulated market and have reduced risk. So all those things, new money entering the market, will increase the price of the commodity. It's just what happened. And so now we might see some other coins start doing this. Ethereum might do it. Bitcoin is first because, Bitcoin is the poster boy of cryptocurrency. Bitcoin's going to do everything first. So now you might see some coins like Ethereum, maybe will do it, which is the second highest market cap, or maybe Ripple, which is the third. So, you might start seeing more coins try to be a part of the futures contract, and that'll just get more traction to them and really just increase their value. So something else that's pretty interesting to think about is if there's so much new money flowing into Bitcoin, the way that the cryptocurrency market works is that people ride the hype. So if the price of Bitcoin is going to rise, people will start to sell their altcoins. So we could see a point where people are starting to sell their altcoins like crazy in order to ride the Bitcoin hype. So it basically will be pretty interesting to see how Bitcoin futures affects the market as a whole. I think that it'll overall increase the price of Bitcoin for a little while. And the purpose of the contract itself is to stabilize the price. So maybe we'll see a stabilized Bitcoin price. Maybe we'll see a market that isn't completely tied to Bitcoin. you know, because generally the way that the market's worked in the past is that if the price of Bitcoin is tanking, then all the other coins will tank too. It's just the way it works. Or if Bitcoin's rising, then, you know, the rest of the coins will rise. So a market where not everything isn't tied to Bitcoin would be nice to see. So hope you guys enjoyed the video. I'm gonna work on this beautiful chalkboard bought with 10 Litecoin. I hope you learned something. Thanks for watching.